Welcome back. Earnings season in full swing, and we are going to look at General Motors, Lockheed Martin, and Philip Morris in today's earnings exchange. They come out tomorrow before the bell. Here with our trade, Jeff Kilburg, KKM Financial founder and CEO, and a CNBC contributor. Jeff, welcome. Good to have you with us. Let's start with General Motors. The shares are up today. 8-day losing streak seemingly in the rearview mirror. Deutsche Bank says GM is the best positioned automaker into earnings with strong pricing, sustained cost-cutting efforts, but Deutsche watching spending on the more speculative EV and cruise programs. What's your view on GM here?
Well, Tyler, I agree with those analysts talking about what they're going to see from a perspective of what's the uncertainty in China. What are they doing with the slowdown in EV? But I want to be a buyer here of GM, and that's due to the fact that it's had a great year to date. It's had a great 1 year, but there's still more room to run. If you look at a 3-year perspective, Tyler, it's still down about 25%. And by and large, at about a 4.7 times forward PE ratio, it's not that expensive. So I think there is opportunity here, but we really are going to be focused. I think it's critical, not just for GM, it's for Ford, it's for all the motor companies to get a better understanding how are they going to handle the slowdown in EV, and more importantly, how are they going to grapple and digest the China uncertainty. But I own Ford as well as GM, but I think GM has the opportunity to move back higher. Just remember, Ty, about 2 years ago, it was trading up over $65. And here in the mid-40s, it seems to be offering a discount.
Yeah, and it's up 46% 6 months, 18% year-to-date, as you pointed out. It has been kind of a stealthy gainer here. Let's move on to Lockheed Martin. Shares flat to start the year despite global geopolitical tensions. J.P. Morgan lists further escalation in the Middle East, delays in F-35 deliveries, and a new air defense contract with the U.S. military as some of the key factors to watch. How would you trade Lockheed into earnings? You'd kind of think that a defense company of this scale would be a market winner. So far this year, it has not been, up 1%.
That's right. And I think if you look at the environment we are geopolitically, this is a name we want to own. This is actually a name that I've owned for quite some time, the Essential 40 portfolio. But if you think about it, this is a blue chip essential defensive name. It's got a yield of nearly 3%. It's got a very low risk profile. If you look at the year 2022, Ty, when you saw the NASDAQ 100, the S&P 500 moving lower, this was able to find some investors to come into the marketplace due to the fact of its risk profile with a beta of only 0.48. So I like the defense contract. It still has some room to run. It is slightly overbought, though, Ty. If you look on a relative strength index measurement, it's above 70. So it's interesting to see the all-time high at $508. Not that much higher in here, but you think the world we're living in, the amount of money we're spending, not just as a government, but as a globe on defense, I think Lockheed Martin moves higher.
All right, let's move on finally to Philip Morris. The shares slightly lower so far this year, but Stifel sees potential in Zyn, its nicotine pouch, and other smoke-free products, while also noting solid growth in its heated tobacco business. What an interesting way to put that, heated tobacco, as the company looks to reduce manufacturing costs for both. What would you do here with Philip Morris?
Well, the heated tobacco, a.k.a. smoke-free tobacco, which is actually, Ty, about 1/3 of revenue now for all of these tobacco companies. But I'm a little bit negative on Philip Morris due to the fact it looks like the technicals are rolling over. I know there is optimism because they will be able to sell. They bought from Altria. It was about a $3 billion price tag, the rights to start selling their heated tobacco or smoke-free tobacco. So I think that will ramp up in late 2024 and potentially 2025 when it's more rolled out domestically. But right now, if you look at this stock for 3 years, it's flat and it's gone nowhere. So this is not where I want to put my money. I can't come up with a pun right now to really give you something, a zinger for Philip Morris, but I'm taking this and putting it on the ashtray. No, thank you.
Thanks a lot, Jeff Kilburg, KKM Financial. We appreciate it.